Welcome to Griffonomics. Today we're diving into SANUWAVE Health, ticker SNWV.
Yeah, and this is one of those deep dives that really twists your brain a bit when you first look at the
Oh,
numbers.
absolutely. I mean, imagine a medical device company that has essentially cracked the code on healing severe chronic wounds, and they are doing it using nothing but low-frequency sound waves and a saline mist.
Right, which sounds like science fiction, but it's not.
Exactly. Now imagine that same company reporting all-time record clinical utilization of that exact technology, only to watch their stock instantly lose like 42% of its value in a single trading session.
Which is just a brutal market reaction.
Brutal. That is the paradox we are unpacking today. We have a massive stack of materials driving this analysis. We're pulling from SANUWAVE's recent 10K and 10Q SEC filings, the Q1 2026 earnings call transcript, a bunch of market sentiment reports, and some really dense Medicare reimbursement reform data.
And you really need all of those sources to even begin to piece this together.
Right, because our core thesis here, the mission of this deep dive, is to explain how SNWV is managing this severe near-term operational friction point. They're facing a sudden capital equipment sales slowdown, which was triggered entirely by an influx of liquidated, pre-owned systems flooding the secondary market.
Yeah, and that surface level slowdown is actively masking an incredibly healthy, high margin, recurring consumables engine running right underneath it.
Exactly. It creates this intense structural tension. You've got short-term revenue guidance just getting hammered, while the underlying clinical utilization for their core hardware platform accelerates to all-time record unit volumes.
The divergence between those two metrics is just staggering when you actually look at the raw filings. You are essentially looking at an optical illusion in the public markets right now.
An optical illusion. I like that.
I mean, it is. The traditional financial vital signs, top line revenue, hardware sales, gross margin percentages, they are all heavily distorted right now by macroeconomic shifts and, frankly, a lot of legacy accounting cleanup.
Yeah, the accounting stuff is wild.
To understand the actual intrinsic value of this enterprise, you really have to bypass the headline numbers. You have to dissect the granular mechanics of their financial restructuring, their supply chain dependencies, and most importantly, this massive regulatory shockwave that completely rewired the advanced wound care industry earlier this year.
So let's start with those distorted vital signs.
Yeah.
Because before we can even talk about their commercial strategy, we have to talk about the forensic accounting cleanup that just dragged their back office through the mud.
Oh, yeah. It's dense.
Very. When you dig into their 10K and the recent 10Q filings, you immediately hit this wall of retroactive financial restatements. Specifically, they had to execute a massive forensic cleanup under SAB 99, which is the rule that governs the materiality of misstatements.
Right. And this wasn't just some minor rounding error in a spreadsheet somewhere.
No, not at all. This was a multi-period state and local sales tax error spanning from 2022 all the way through 2025.
Yeah, and the root cause of that specific liability really goes back to the complexities of economic nexus laws.
Right, which are a nightmare.
Total nightmare. They've been a labyrinth for microcap companies ever since the Supreme Court's Wayfair decision. Basically, SANUWAVE historically operated under the assumption that they only needed to collect and remit sales taxes in states where they had a physical presence.
So like physical offices, warehouses, or actual W-2 employees in that state.
Exactly. But they brought in a third-party specialist to conduct a comprehensive sales and use tax nexus study. And that audit uncovered a massive blind spot. Because they were expanding their sales footprint nationally, they had actually crossed the economic nexus thresholds in multiple jurisdictions without even realizing it.
Because they were selling so much product in those states.
Right. They had a legal obligation to collect taxes based purely on the volume of revenue generated in those states, whether they had a physical footprint there or not.
And because they hadn't been accruing those liabilities, they suddenly had to add $3.08 million to their accrued expenses.
Which is a huge number for a company of this size.
It is a brutal hit. I mean, it directly expanded their cumulative fiscal year 2024 net loss to $33.1 million. But what fascinates me is how they handled the fallout.
Oh, they handled it textbook.
Yeah. They didn't just quietly accrue the liability and, hope the states wouldn't notice. They executed a strategy using voluntary disclosure agreements, or VDAs. They proactively approached almost all the applicable state tax authorities, admitted the multi-year oversight, and offered to pay the back taxes.
Well, proactive disclosure is really the only survivable path when you uncover a liability of that scale. By initiating the VDAs, SANUWAVE achieved two critical financial protections.
Write those down for me.
Sure. First, they limited the look-back periods. Instead of a state auditing them for the past 7 years, the VDA often caps the liability to just the trailing 3 or 4 years.
Okay, that makes sense. It stops the bleeding.
Exactly. Second, and honestly more importantly, it usually results in the absolute abatement of the punitive financial penalties that states slap on unremitted taxes. And those penalties can often exceed the actual tax principal itself.
So it forced a really painful, non-recurring cash hit to the balance sheet, but it fundamentally ring-fenced the liability and prevented it from becoming an existential threat.
Exactly.
But the state tax issue was just the appetizer. The far more complex restatement involved the ASC 606 extended warranty misallocation.
Yeah, this one is tricky.
I read through the technical footnotes on this, and it is honestly a masterclass in how easy it is to accidentally front-load revenue if your internal controls aren't airtight.
It happens more than you'd think.
So under ASC 606, when a company sells a bundled contract, let's say, a $10,000 UltraMIST system package with a $3,000 extended warranty, if they sell that entire bundle to a hospital network at a discount, there are very strict rules about how you actually recognize that money.
Right, because the core philosophy of ASC 606 is that revenue must be recognized when and only when a specific performance obligation to the customer is satisfied.
So delivering the machine is one obligation.
Exactly. The physical hardware is satisfied upon delivery, but the extended warranty is satisfied linearly over a multi-year period. The accounting failure here occurred in how SANUWAVE allocated the contract discounts.
Right.
Historically, they were absorbing the entire discount into the extended warranty performance obligation. They were keeping the transaction price allocated to the physical system hardware at its maximum standalone value, while effectively pricing the deferred warranty at near zero.
Let's run the math on that for the listener, because the implications on the earnings reports are massive.
Please do.
So if that $13,000 bundle is discounted by $3,000, the hospital only pays $10,000. Under the old, incorrect method, SANUWAVE booked all $10,000 as immediate hardware revenue upon shipment and booked $0 for the multi-year warranty liability.
Right, which creates a massive artificial pop in current period earnings.
Huge pop. But ASC 606 requires that $3,000 discount to be spread proportionally across both items based on their relative standalone selling prices.
Which means a significant portion of that initial $10,000 actually belongs to the warranty liability. So SANUWAVE had to go back through multiple quarters in 2024 and 2025, reverse the artificially inflated hardware revenue, and shift it into deferred contract liabilities on the balance sheet.
They had to systematically defer revenue out of the past and push it into the future.
Exactly. And it is crucial to understand that this does not change the total cash collected by the business. The lifetime value of the contract remains completely identical.
Right, the cash is the cash.
Yeah, but optically, it forces a downward restatement of historical top-line growth. And algorithmic trading models interpret that as a fundamental business contraction rather than just a technical accounting reallocation.
Right. So if you are an allocator looking at these filings, you have to ask yourself, is this malicious Enron-style financial engineering designed to trick investors? Or is it just the chaotic reality of a microcap company outgrowing its legacy back-office infrastructure?
And looking at the evidence, it's definitely the latter.
I agree. The aggressive deployment of third-party auditors, the voluntary disclosures, and the willingness to just take the public relations hit of a SAB 99 restatement, it all points heavily toward a management team actively exercising old demons.
Yeah, they are establishing the baseline financial hygiene required for real institutional investment. And honestly, the timing of that financial cleanup was not coincidental at all.
Definitely not.
It was a mandatory prerequisite for overhauling their capital structure. Institutional lenders operate on absolute data fidelity. You just cannot secure Tier 1 debt financing if there are lingering questions about your revenue recognition protocols or, hidden state tax liability.
Right. SANUWAVE had to scrub the books clean because they were actively suffocating under the weight of their legacy balance sheet.
Suffocating is the right word.
Which brings us to the banking telemetry and the absolute transformation of their corporate debt. So prior to September 2025, SANUWAVE was strapped with a highly restrictive 15% senior secured debt facility.
15%.
Yeah. Paying 15% interest is essentially corporate payday lending. It drains operational cash flow so aggressively that management is forced to manage the business just for the next debt payment, rather than long-term strategic growth.
Right. You can't invest in R&D or sales expansion when you're just servicing debt.
Exactly. But they executed a landmark credit agreement with JPMorgan Chase. They secured a $23 million amortizing term loan alongside a $5 million revolving credit facility and completely retired that toxic 15% paper.
And the structural difference between those two debt instruments completely alters the company's operational runway. The legacy debt was this high-yield, non-amortizing anchor. The new JPMorgan architecture is priced dynamically off the secured overnight financing rate, or SOFR, plus a spread.
Which mathematically halved their annual interest burden.
Halved it. In fiscal year 2024, they were bleeding $13.78 million in interest expenses. Post-restructuring, that annualized run rate dropped to roughly $6.25 million.
That's incredible. And if you isolate just the Q1 2026 data, the interest expense plummeted 71% year over year down to just $546,000. That is millions of dollars in free cash flow permanently injected back into the operating model.
It is. And this is but there is a massive execution variable attached to that JPMorgan term loan.
Oh, for sure.
The old toxic debt was a largely interest-only until maturity. The new facility requires mandatory quarterly principal amortization payments of $1.4 million.
So while the interest rate is vastly superior and the restrictive operational covenants are basically gone, management now faces a strict cash flow hurdle every 90 days.
Every single quarter.
They basically traded a loan shark for a traditional mortgage. The interest rate is much better and they aren't going to get their knees broken, but they still have to make that heavy principal payment every single quarter, which demands absolute commercial execution with zero margin for error.
That amortization schedule fundamentally changes the urgency of their cash generation strategy. And that urgency is really compounded by the severe regulatory penalty they triggered regarding their historical losses.
Ah, yes. The NOLs.
Right. So a company that has operated at a deficit for years accumulates net operating losses, or NOLs. SANUWAVE had amassed an accumulated deficit exceeding $244 million.
Which is massive.
Massive. And in theory, those NOLs act as a huge tax shield, allowing the company to offset future taxable income and protect their future profits from federal taxation.
But they blew up that tax shield in October 2024.
They did.
They executed a reverse stock split, combined with a private investment in public equity, or PIPE transaction. The mechanics of that move saved the company from delisting, and it infused critical survival capital. But it mathematically triggered a Section 382 change of control under the IRS tax code.
Which is a huge penalty.
Huge. The reverse split shrank the existing share count, and the PIPE issued a flood of new shares to incoming institutional investors, diluting the legacy shareholders well below the 50% ownership threshold.
And the IRS implemented Section 382 back in the 1980s specifically to combat corporate tax farming. They wanted to prevent highly profitable conglomerates from acquiring distressed, failing companies solely to harvest their massive NOLs and wipe out their own tax liabilities.
Right. They were just buying the losses.
Exactly.
Yeah.
So the rule dictates that if a company undergoes an ownership change greater than 50% over a rolling 3-year period, their ability to utilize historical NOLs is permanently and severely restricted.
So for SANUWAVE, this penalty caps their federal NOL utilization at a maximum of just $4 million annually for the first 5 years.
Yeah.
After which the cap plummets to a mere $1.3 million per year.
The downstream financial impact of that Section 382 trigger is just brutal. When you look at the deferred tax asset schedules in the filings, you realize that an incredible $44.2 million of deferred tax attributes will now expire completely unutilized.
Wow. $44 million just gone.
Just gone. They had to permanently write off a massive percentage of their historical tax shield just to secure the capital required to keep the lights on. It was this Faustian bargain, but arguably the only mathematically viable option available to the board at the time.
It cleared the path for the JPMorgan facility.
Yeah.
But stabilizing the balance sheet was really only phase 1 of the turnaround.
Right.
Because while the CFO was managing the debt restructuring, the commercial team was dealing with a massive polarization in their actual sales data. We have to analyze the razor and blade divergence that is currently defining their top-line trajectory, because the underlying mechanical variables are incredibly counterintuitive.
They really are.
Let's set the baseline with the fiscal year 2025 numbers. The total revenue profile was expanding rapidly, growing 35% year over year to $44.5 million.
Which is great growth.
Phenomenal. Systems hardware, The physical UltraMIST consoles grew 61% to $17.8 million. But the true economic engine of the business, the sterile, single-use consumable applicators required for every single patient treatment, remained the dominant revenue component at $25.8 million.
And this is the classic razor and blade model operating at peak efficiency.
Exactly. The more handles you place in the field, the more recurring revenue you generate from the replacement blades.
But then you transition to the Q1 2026 data, and you see a violent mechanical correction in the hardware segment. Capital equipment system sales just collapsed. They fell 58% sequentially from the previous quarter, landing at a meager $2.9 million.
And the market interpreted this as a fundamental breakdown in demand for the technology.
Right, the stock price plummeted. However, if you look at the simultaneous data for the consumable applicators, underlying unit volume actually jumped 15% year over year and 3% sequentially.
Wait, let me get this straight. The hardware sales tanked by 58%, but the applicator units actually hit an all-time record.
Yeah, exactly. They hit an all-time record in applicator unit sales. The hardware sales evaporated, but the clinical utilization of the existing hardware base accelerated to unprecedented levels.
That divergence is the single most important metric for any allocator evaluating this enterprise right now, because the installed base of active systems actually grew by 90 units sequentially, ending Q1 at 1,382 active systems in the field. But the way those systems are being monetized is changing, largely due to a massive structural shift in their go-to-market strategy. They executed a wholesale reseller transition, systematically converting their long-standing legacy distributors into direct resellers.
And the financial architecture of that transition is deeply complex. Historically, SANUWAVE operated on a retail billing model. They sold the hardware at a high gross price, but they incurred massive liability on the back end through heavy ongoing sales commissions paid to their outside distributor network.
Right.
In 2024, exactly 0% of their hardware flowed through this reseller channel. By 2025, they had aggressively shifted 34% of their total hardware volume into the new wholesale model.
I have to push back on the optics of this strategy, though, because at first glance, it looks like pure margin destruction.
It does look bad on paper.
Right, because when you shift to a wholesale reseller model, you are granting immediate upfront bulk discounts to the reseller. This permanently compresses your average selling price per unit. And the direct result of this shift dragged their Q1 gross margins down to 77.3%.
Which analysts hate.
Exactly. If moving to wholesale permanently compressed average selling prices and dragged Q1 gross margins down, isn't that a net negative for the company? Why deliberately compress your selling price and shrink your gross margin percentage on your core capital equipment?
Well, it is only destructive if you isolate the gross margin line and completely ignore the operating leverage generated lower down on the income statement. You have to analyze the trade-off.
Okay, unpack that trade-off.
Yes, the wholesale discounts compress the top-line gross margin percentage. But by converting those legacy distributors into independent resellers, SANUWAVE systematically severed the heavy, lingering liability of outside commission expenses. In fiscal year 2025 alone, this strategic transition slashed their legacy commission outlays by $1.9 million. Yeah. So they sacrificed a few hundred basis points of gross margin in exchange for a massive permanent reduction in operating expenses.
So it vastly improves the net operating income while simultaneously accelerating the physical placement of the devices.
Exactly.
Because a well-capitalized wholesale reseller has their own established logistics network, right? They can absorb the hardware in bulk and deploy it into regional hospital systems much faster than SANUWAVE's internal direct sales force ever could.
Right, and the faster you increase that installed base of hardware, the faster you feed the high-margin recurring consumable engine. It is a highly defensive maneuver designed to optimize cash flow rather than just protecting a vanity gross margin metric.
But even with the wholesale transition accelerating placements, it doesn't fully explain the 58% sequential collapse in Q1 capital equipment sales.
I know, it doesn't.
To understand why hardware sales hit a brick wall, we have to look outside the company's internal operations. We have to examine the macroeconomic shockwave that hit the entire advanced wound care industry in early 2026.
And this is the big one. The Centers for Medicare and Medicaid Services, or CMS, essentially dropped a regulatory anvil on the market, triggering a massive dislocation.
The scale of this CMS overhaul just cannot be overstated. For years, The advanced wound care space relied incredibly heavily on biological skin substitutes and cellular tissue
Right,
products.
the allografts?
Yeah, these are allografts derived from human or animal tissue used to cover severe diabetic and venous ulcers. But the financial trajectory of these products became fundamentally unsustainable for the federal government. Medicare Part B spending on these specific skin substitutes exploded from roughly $252 million in 2019 to over $10 billion by 2024.
Wait, $10 billion?
Over $10 billion.
That is insane growth. And whenever a specific Medicare expenditure curve goes exponential like that over a 5-year period, it triggers aggressive federal intervention. CMS investigators uncovered a deeply compromised incentive structure. Certain manufacturers and distributors were heavily marking up the acquisition costs of these biologicals, while practitioners were billing CMS at inflated rates, pocketing the massive spread.
So they were making a profit on the material itself.
Exactly. It created a perverse incentive to utilize the most expensive biologicals possible, regardless of the baseline clinical necessity. CMS realized they were hemorrhaging billions of dollars into a highly opaque billing ecosystem.
So effective January 1st, 2026, CMS executed a lethal regulatory strike. They abandoned the old variable pricing models entirely and instituted a strict flat-rate reimbursement model of $127.28 per square centimeter for skin substitutes.
Regardless of the brand or the manufacturer's underlying cost structure.
Exactly. They commoditized the entire biological market overnight. And they didn't just cap the future prices, they launched incredibly aggressive audits and retroactive clawbacks targeting historical claims.
And the administrative burden shifted instantly. CMS demanded that documentation explicitly support medical necessity, detailed clinical rationale, and precise, millimeter-accurate wound measurements for every single application.
Our providers across the country began receiving additional document requests, or ADRs, forcing them to justify years of past billing or face immediate financial recoupment.
Which is terrifying for a small clinic. The combination of the new flat rate cap and the retroactive audits triggered what SANUWAVE management accurately described as the shock pause.
The shock pause paralyzed the entire industry. January hit, the rules went live, and thousands of practitioners simply froze. They stopped ordering new supplies, they delayed treating complex patients, and many held out hope for some sort of 11th-hour legislative rescission or legal injunction.
But CMS held the line.
They held the line, and this created immense catastrophic financial stress for the smaller, undercapitalized clinics, particularly those operating in the mobile wound care sector.
Because if you are running a regional mobile wound care clinic and your entire profit engine relies on the spread between the wholesale cost of biologicals and the old CMS reimbursement rate, the new flat rate model instantly inverts your margins.
Right. The acquisition costs for premium skin substitutes suddenly exceeded the $127 reimbursement cap.
Clinicians were mathematically losing money on every treatment.
Losing money every time they're treated a patient. Consequently, a massive wave of these smaller, highly leveraged clinics went bankrupt and were forced into immediate liquidation.
And this is exactly where the macroeconomic chaos bleeds directly into SANUWAVE's Q1 financial collapse. When these bankrupt clinics liquidated their assets, they didn't just throw their specialized medical equipment away.
Right. The bankruptcy courts ordered the assets sold to recoup creditor losses.
Exactly. Which flooded the secondary market with hundreds of pristine, slightly used UltraMIST systems at massive fire sale discounts.
The cannibalization effect was immediate and severe. If you are a hospital procurement director or a cost-conscious wound care network looking to expand your capabilities, why would you authorize the purchase of a brand new UltraMIST console directly from SANUWAVE for tens of thousands of dollars when you can acquire the exact same technology on the secondary market for pennies on the dollar?
You wouldn't. The secondary market supply completely absorbed the industry's demand for new hardware, causing SANUWAVE's direct system sales to plummet by that 58%.
It's like the federal government suddenly spiked the commercial price of diesel fuel to $30 a gallon, forcing a massive wave of regional logistics companies into bankruptcy overnight. The bankruptcy courts then liquidate their fleets, flooding the commercial auto market with thousands of pristine used delivery vans at a steep discount.
That's a great way to think about it.
Right. It makes it mathematically impossible for the van manufacturer, like Ford or Mercedes, to sell a brand new van that quarter, even though the overall macroeconomic demand for package deliveries hasn't changed at all. The underlying need for the utility remains constant, but the supply side of the hardware channel is totally distorted by the liquidations.
The van analogy perfectly captures the structural tension here. The diabetic patients with chronic, non-healing ulcers haven't disappeared. The clinical demand for effective wound closure is higher than ever. But the capital equipment pipeline is clogged by the secondary market overhang.
Which forced SANUWAVE management into a very painful corner regarding Wall Street expectations. They had to drastically revise their near-term projections, dropping their Q2 2026 revenue guidance down to a range of $8.5 million to $9.5 million.
And the market reaction to that guidance downgrade was violently negative, driving that 42% single-day collapse in the share price. The algorithmic trading models and the short sellers focused entirely on the capital equipment softness. They interpreted the secondary market cannibalization as a fundamental failure of the technology's commercial viability.
But the bears are completely ignoring the insulated silver lining embedded deep within the CMS regulations.
Yeah.
You have to analyze how SANUWAVE's actual therapy is mechanically classified and reimbursed by Medicare.
Yeah, this is where the underlying biological science of the UltraMIST device becomes the ultimate financial moat, because UltraMIST is not a biological skin substitute.
Right, it's a machine.
It is a low-frequency, non-contact ultrasound therapy. The device transmits acoustic sound waves through a continuous saline mist directly into the wound bed without ever physically touching the compromised tissue.
Which is incredible.
It is. The clinical efficacy is driven by acoustic cavitation, the formation and collapse of microscopic bubbles within the tissue fluid, which physically disrupts bacterial biofilms, stimulates angiogenesis or new blood vessel formation, and promotes vasodilation, flooding the wound bed with oxygenated blood.
And because the biological mechanism of action is completely different from applying a cellular tissue product, the clinical billing code assigned to the UltraMIST therapy CPT 97610 emerged from the CMS regulatory purge fundamentally untouched.
Totally untouched. CMS did not slash the reimbursement rate for non-contact ultrasound because the therapy wasn't the source of the $10 billion expenditure crisis.
Right. The clinical economics of operating an UltraMIST device remained completely stable, while the biological competitors were structurally kneecapped.
So the macro environment is actually aligning the clinical and financial incentives perfectly in SANUWAVE's favor over the long term. The broader health networks are rapidly consolidating. They are absorbing the patient volume left behind by the liquidated clinics. They are operating under intense margin pressure, and they desperately need effective, evidence-based alternatives to the expensive biological allografts that CMS is aggressively auditing.
Exactly. SANUWAVE provides a therapy that is clinically proven to heal complex wounds, requires minimal physician time to administer, and, crucially, is fully supported by a stable, predictable Medicare reimbursement code that isn't going to trigger a retroactive federal audit.
The strategic positioning is brilliant, but the company's ultimate survival and its ability to service that new JPMorgan debt amortization schedule we talked about relies heavily on its supply chain architecture and its ability to monetize hidden assets.
Yeah, let's look at that supply chain, because the reality is that SANUWAVE operates a highly concentrated, asset-light manufacturing model. They have consciously traded operational flexibility and redundancy for the strict cost efficiency of single-source manufacturing.
Right. When you dissect their procurement data and the 10K risk factors, you see intense single-source dependencies that introduce significant execution risk.
Yeah, tell me about it.
SANUWAVE relies exclusively on no-tech systems located in Maple Grove, Minnesota, for the engineering and generation of the UltraMIST hardware consoles. Simultaneously, they rely entirely on a long-term supply agreement with Dynamic Group, based in Ramsey, Minnesota, to manufacture the high-margin sterile applicator wands.
So all of it is in Minnesota?
All of it. In Q1 2026, those two vendors alone accounted for roughly 37% of the company's entire consolidated corporate cash outlays.
But wait, if the recurring consumables, those sterile applicator wands, are the absolute golden goose driving the long-term profitability of this enterprise, relying entirely on one manufacturing facility in Minnesota seems terrifying.
It is a major risk factor.
What happens if Dynamic Group experiences a catastrophic fire on the production floor, or a massive labor strike, or a localized supply chain collapse involving the specific medical-grade plastics required for the wands? Isn't that an existential threat? The entire revenue engine of SANUWAVE would instantly seize up.
The supply chain concentration is undeniably the most acute physical vulnerability the company faces. The regulatory reality of medical device manufacturing means you cannot simply pivot to a backup factory overnight.
Because of the FDA.
Right. Spinning up a secondary sterile manufacturing line for Class 2 medical devices requires extensive FDA validation protocols, rigorous quality management system audits, and millions of dollars in capital expenditure, a process that can take upwards of 18 to 24 months.
So they are locked in.
They are. Management is fully aware of this single point of failure risk, but building redundancy requires capital they currently need for debt amortization and sales expansion. It is a calculated vulnerability that investors must explicitly underwrite.
But on the exact opposite side of that physical vulnerability, we have to look at their intellectual property portfolio. Because they executed a masterstroke of asset monetization in 2025 that fundamentally saves the balance sheet.
This is one of my favorite parts of their story.
It's brilliant. SANUWAVE's foundational technology isn't just limited to external wound care. They held a highly specialized legacy portfolio of patents regarding the application of acoustic shock waves for intravascular lithotripsy.
Essentially using sound waves to break up calcified plaques inside human blood vessels.
Right. But because intravascular cardiovascular devices were far outside their core wound care focus, they made the strategic decision to monetize the IP.
The divestiture of that intravascular portfolio was a massive financial catalyst. They initially entered into an exclusive license and option agreement in 2024, securing an upfront payment of $2.5 million. Then, in July 2025, the licensee formally exercised their purchase option to acquire the entire patent family outright, triggering an immediate $5 million cash windfall paid directly to SANUWAVE.
And the accounting mechanics of that transaction are incredible. Because the underlying legacy patent portfolio had been fully amortized or internally developed over the years, it carried a historical capitalized book value of $0 on the balance sheet.
$0.
Therefore, SANUWAVE was able to record the entire transaction as a clean $5.38 million pure gain on the sale of patents.
That zero book value windfall just transformed the corporate narrative. It permanently drove their GAAP net income to $11.8 million for the fiscal year. But more importantly, a sudden infusion of unencumbered cash provided the liquidity required for management, fully backed by their independent auditing firm, to formally alleviate the going concern warning that had plagued their SEC filings for multiple consecutive years.
That is a monumental milestone for a microcap company.
It changes everything.
Because removing a going concern warning fundamentally changes how the enterprise is viewed by external stakeholders. It signals to large hospital procurement boards that SANUWAVE is financially viable, strongly capitalized, and guaranteed to be around to provide warranty support and consumable inventory for the multi-year life cycle of the equipment they are selling. It completely de-risks the adoption curve for cautious, enterprise-level clients.
Exactly. So synthesizing the complete investment case really requires weighing all these intersecting variables. You have an enterprise trading near its multi-month technical floor of $7.53.
Right.
The market capitalization reflects the severe punishment inflicted by the Q2 revenue guidance downgrade and the optical deterioration of the gross margins. The critical question for allocators is whether this depressed valuation represents an asymmetric disconnect, or if the secondary market headwinds are simply too severe to overcome.
If you summarize the core thesis we've unpacked today, SANUWAVE represents a high-margin clinical utility company currently masked by a temporary, macro-induced hardware inventory correction.
Yep.
The recurring revenue engine is fundamentally intact and accelerating. The underlying clinical outcomes are proven. The reimbursement code is highly stable and untouched by the CMS purge. They have systematically cleaned up their historical accounting liabilities, restructured their toxic debt into a manageable SOFR-based facility, and eliminated the going concern warning.
That defines the bullish asymmetry perfectly. However, realizing that value requires management to navigate three highly specific execution risks flawlessly over the next 12 months.
Let's lay those out. What's number one?
The first is the ongoing secondary market cannibalization. We simply do not have precise telemetry on the depth of the liquidated UltraMIST inventory currently circulating among resellers.
Right, we don't know how many used machines are still out there.
Exactly. Until that secondary market supply is fully absorbed by consolidating clinics, SANUWAVE will continue to face intense friction in closing new, high-margin capital equipment sales.
And the second massive execution risk is the single-source manufacturing vulnerability we discussed regarding Nortec and Dynamic Group. Any severe disruption in Minnesota directly and immediately severs the company's ability to generate revenue.
Yep. And the third risk, which might be the most daunting in the near term, is the incredibly steep execution ramp required to hit their full-year guidance. Despite the Q1 collapse and the muted Q2 projections, management defiantly maintained their full-year revenue target of $51 to $55 million.
The math behind that guidance requires a heroic second half of the year. Following a weak Q1 of $9.6 million and a projected Q2 of roughly $9 million, they need to generate nearly $36 million in the back half of the year just to hit the top end of their range.
Which is a huge jump.
It is. They are relying on a massive hockey stick recovery curve in Q3 and Q4, driven by fleet-wide adoptions from large national hospital networks that are currently evaluating the technology.
And during the earnings call, the CEO explicitly addressed the friction involved in closing those large enterprise deals. He referred to it as the magic taser gun problem.
The magic taser gun problem.
Yeah. He acknowledged that hospital procurement boards are inherently skeptical of a device that claims to heal massive necrotic wounds by shooting sound waves through a saline mist. They view it as science fiction until they actually run the clinical trials in their own facilities and watch the wounds physically close faster than traditional therapies.
The historical data shows a massive 48% second-half seasonality trend as these enterprise valuations convert into bulk purchases. But the real question is that historical 48% second-half seasonality enough to save their year?
That is the defining execution variable that will dictate the stock's trajectory. If the shock pause continues to thaw and those national accounts successfully complete their valuations and issue fleet-wide purchase orders, the $55 million target is mathematically achievable.
But it demands absolute perfection.
Absolute perfection from their direct sales force and their wholesale reseller network. They cannot afford extended procurement delays, and they must generate enough operating cash flow to seamlessly cover those $1.4 million quarterly JPMorgan amortization payments.
It is a high-wire act of corporate resilience. SANUWAVE serves as a textbook case study in how a company possessing a fundamentally strong, high-margin, clinically proven product can still be temporarily brought to its knees by sudden, uncontrollable macroeconomic regulatory shifts and the bizarre downstream dynamics of a flooded secondary market.
Right. They have successfully cleaned up their past, fortified their balance sheet, and secured a clear operational runway, but they are fighting a brutal uphill battle to clear out the lingering ghosts of liquidated mobile clinics.
The overarching lesson for healthcare allocators is that technological efficacy is only one component of commercial viability. Regulatory positioning, supply chain architecture, and the complex dynamics of reimbursement channels are equally, if not more, critical to long-term enterprise valuation. Which leaves you with a broader macroeconomic question to ponder as we close out today's deep dive. As Medicare continues to aggressively push the philosophy of care to the edge, moving treatments out of expensive hospitals and into local clinics and patients' homes, and as they mercilessly slash reimbursements to curb their $10 billion spending problem, who will truly dominate the next decade of medical technology?
That's the billion-dollar question.
Will the winners be the companies developing the flashiest, most complex, and expensive new biological therapies? Or will the market ultimately reward the pragmatists, the companies that can deliver the most undeniably cost-effective, easily deployable clinical utility to cash-strapped hospital networks? Because right now, the diagnostic landscape might look incredibly murky, but the underlying vital signs of a recurring revenue utility like SANUWAVE seem perfectly engineered for the harsh new reality of advanced wound care. Until next time, keep diving deep.